Hello, CFA candidates. Welcome to this segment of derivatives. In this part, what we do is to determine the value of the forward contract during its life by looking at the movement in the underlying compared to the forward price we've agreed to pay. So here is your formula. The value to the long at any point in its life, so I'll say point t at time t. The ST is just the spot price of the underlying asset at time t, minus the forward price you've agreed to pay, over 1 plus risk-free rate to the t minus t. In other words, just the present value of the forward price. That's all the 1 plus risk-free rate to the t minus t is doing this. Lowercase t is telling us when we're at, so let's say we signed up to a 100-day contract. This might be 40 days in. Well, that means if it was initially 100-day contract and we are 40 days in, we need to discount back by 60 days. So don't get bogged down in writing down in detail what uppercase T means. Lowercase t means just accept that we are discounting the forward price from the end of the contract back to the current point in time. Now I think that's fairly logical. Because all we're looking at is what you're going to receive as the long, less the present value of what you have to pay. If we're considering the short position, it is just the opposite. So it's the negative of the long. It's a zero-sum game, so for long has a gain. The short has a loss and vice versa. So to summarize, this is what we're looking at. The value of a long at initiation is 0. We price it to prevent arbitrage. When we get to maturity, what will happen if we're long? Well, we'll receive the underlying asset. At time t we will get that value and will pay out the forward price we agreed, so that would be our gain or loss. Anytime in between, what we get is the present value of the underlying maturity minus the present value of the forward price we agreed to pay. So as we throw in the formula, if you're valuing at any point during its life, it's the spot price of the underlying less the present value of the forward price. So let's start putting it into practice, starting off with equity forwards. Understand as we go through equities, then index, then fixed income and so on. We are going to keep applying the same concepts over and over. This happens to be equity, so we're going to look at dividends. But when we get to bonds there may be coupons. But the idea is this. If there are interim cash flows on a forward contract, such as dividends and coupon, they are considered benefits of carry, which reduce the forward price. Our basic model when we priced considered the cost of carry. The classic is the risk-free rate. So if you have to buy the asset today and hold it, then you incur the cost of the risk-free rate. The cost of carry, or the time value of money. That's offset by the benefits of carry. That could be dividends or coupon. You miss out on these dividends or coupons over the life of the contract, so we'll have to build that into our formula. And this is how we do it. Pricing our equity for forwards using our cost of carry and our benefits model will look like this. Our forward price on an equity is now going to be S0. And we'll grow it at the risk-free rate using our cost of carry model. However, what we're going to do is offset that cost of carry with the benefit of carry, that is, the dividends. And to do that, here's our new piece. We will reduce the spot price by the present value of the dividends that are due. So we'll take the spot price and knock off the present value of those dividends. Why? Well, before the end of this contract life, there are dividends due which I am going to miss out. So, I need to reduce the value of the asset by the present value of those dividends. So in summary, you take the spot price, knock off the present value of those cash flows that are due before the contract expires. And then grow that at the risk-free rate. That's it. Now you'll see a second formula there. It is identical. Which one you want to use will depend on the information you've got. For example, the examiner may give you the present value of dividends. That makes it easiest to use the first version. They may give you the future value. Easiest to use the second. So let's put that into practice. And see how we can price this contract, and then we can see the impact of these dividends on the valuation. So what we got: calculate the no arbitrage forward price for a 100-day. forward on a stock that's currently priced at $100. So there's our spot expected to pay dividends, $5 in 20 days, $10 in 30 days, $15 in 90. First thing I would do. Let's look at this maturity date. The contract matures in 100 and work out which of those dividends we are going to miss out on. In this case, all of them. Annual risk-free is 5%. So we can just apply that 5%. So how do we put into practice? First step. Let's calculate the present value of the dividends that we will miss out. By discount them at the risk-free rate, which is 5%. And we'll do it to the power 20, 30 and 90 over 365. The number of days obviously. The PV of those dividends comes to $29.77. Next, all we need to do is take the current spot price, knock off the present value of the dividends we've just calculated, and grow it at 1 plus risk-free rate to the power t. T is the maturity we want to grow this amount from today to the end of the contract in 100 days' time. I'm gonna end up with that $71.18. Once again. The underlying minus the PV of the dividends. Then grow it at 5% for 100 out of 365 days. What about the valuation? Well, we've got the price that's now going to allow us to go on and do this valuation formula. So let us continue with our previous pricing example. Important to note in the exam this wouldn't happen in two separate questions. They can't ask you to price it. And then in another question to value it. Because the valuation is dependent on the price you came up with. These would have to be separate questions. So here after 60 days. Note that it was a 100-day contract. 60 days have passed, so I think there are 40 remaining. Secondly, you have to think about what's happening with the dividends. We had dividends due first 60 days and a dividend due in 90 days. Well, the 20 days and 30 days dividend are gone. Do a timeline. At time 0, we had a dividend due in 20, 30 and 85 days. We are now 60 days later. That means those dividends of 20 and 30 days are gone. Therefore, they are irrelevant for our calculation. Well, we're at T60. That means the dividends of 90 days will happen after 30 days. So 60 days later, value of the stock is $110. Free rate is still 5% with a flat yield curve. And as we said, there's one dividend left. It's due in 30 days and it is $15. So if you take your $15 discount it by 5% for 30 days, we get $14.94. That is the present value of the single dividend that's left before maturity. Okay, that allows us to come up with a valuation at T60. We need the spot minus the present value of the dividends we just calculated. Less the present value of that forward price. Well, how many days do we need to discount that forward price by? When we signed up it was 100 days away. 60 days have passed. We need to discount that back 40 days. So let's do it. The value is the current spot, that is, $110, minus the present value of the cash flow we miss out of $14.94. Minus the present value of the forward price you agreed, discounted at 5% for the 40 days that remain. Then, you will get $24.26. We are done, we have valued an equity forward. Okay, what about index forwards? When we had a single stock, we could look at that single stock and we know exactly the dates when it's going to pay out a dividend. If we've gone into a forward on an index, that's a lot of stocks. I'm just going to be a lot of dividends paid. So how do we deal with it? Well, usually by assuming it's going to pay out a continuous dividend. The continuous dividend will offset the cost of carry. As we said earlier on borrowing, cost takes money away. The continuous dividends give some of it back, so it's offsetting. But how to deal with this continuous dividend? Well, what we'll do is use continuous compounding, very similar formula. Well, the forward price is the spot today S0 as it always has been. But this time using continuous rates. We multiply by E exponential concepts in your calculator to the power of the continuous risk-free minus the continuous dividend. The continuous risk-free here is growing the price by the risk-free rate, minus the continuous dividend yield that is reducing it by the value of the dividends we miss out on, multiplied by T time to maturity. Putting it into practice, let's imagine it is a forward on the S&P. So the current index is $100. We have continuously compounded risk-free rate of 5% and we have a continuous dividend yield of 2%. Calculate the forward price of a 100-day contract. These are the good habits you want to get into when you see the item set, label everything up. There's the formula you need to put it into practice. $100 is our spot current value of the index times e to the power of risk-free rate, the 5% as a decimal, minus the continuous dividend yield of 2%. Then, times T. What do we have in here? It's a 100-day contract. We are using effective rates here. These are continuous but still 365 days, so multiplied by 100 over 365. Put that through your calculator. Make sure you know how to use your calculator. So what you're going to do in here I would say is 0.05, 0.02 first. Multiply that by your 100 over 365. And you have $100.83. Your next step would be to go on and use that $100.83 to come up with the value of an index contract. However, in the syllabus when we're going from pricing to valuation, we tend to do it for individual stocks. So when we move on to an index and we're using continuous compounding, I would expect to only have to work those numbers to come up with a price. Thanks for watching and please subscribe to my channel.